September was volatile for global markets, influenced by China's economic policies. The Chinese government announced stimulus measures to revitalize its economy. These measures injected optimism, but uncertainties remain. Investors are watching to see if these measures will stabilize China's economy. Investors should brace for continued volatility as the world watches China. China, facing a slowdown in its post-pandemic recovery, rolled out a series of targeted measures. These measures were primarily aimed at boosting consumer spending and stimulating investment. One of the key interventions involved injecting liquidity into the financial system. This was done through a combination of interest rate cuts and increased lending quotas for banks. Additionally, the government announced tax breaks and financial incentives for specific sectors, particularly those related to infrastructure and technology. These measures, while welcomed by many, also raise concerns. There are worries about the sustainability of debt-fueled growth and the potential for these measures to exacerbate existing imbalances within the Chinese economy. The effectiveness of these measures in achieving their intended goals remains to be seen. However, their announcement sent ripples through global markets, underscoring China's undeniable influence on the global economic landscape. Global markets reacted to China's stimulus with optimism and caution. The US S&P 500 and Nasdaq saw an uptick. This sentiment spread to Australia, boosting the ASX 200, but concerns about China's deep economic issues tempered the euphoria. The MSCI World Index saw modest gains, reflecting cautious optimism. Portfolio adjustments banking on value, riding the resources wave. We made strategic adjustments in September, trimmed holdings in Macquarie Group, ticker ASX MQG. Rising interest rates could pressure profit margins, locked in profits, redeployed capital to better sectors. Resources sector buoyed by China's stimulus offers opportunities, maintained positions in mineral resources, ticker ASX MIN. Strong operational performance and exposure to critical minerals. Section 5. Resources sector thrives. A rising tide lifts all boats. The resources sector emerged as one of the best performers in September, largely driven by China's commitment to infrastructure spending as part of its stimulus package. This renewed focus on infrastructure projects, particularly in areas such as renewable energy and transportation, has fueled demand for key commodities like iron ore, copper and lithium. Australian miners, with their significant exposure to these commodities, have been major beneficiaries of this trend. However, it's essential to recognize that not all boats are lifted equally by this rising tide. The performance within the resources sector has been uneven, with companies involved in the production of specific commodities such as lithium and copper, outperforming those more reliant on iron ore, where prices have been more volatile. Section 6. Consumer staples and energy lag headwinds persist despite stimulus. While some sectors benefited from China's stimulus measures, others faced continued headwinds. Consumer staples, typically considered a defensive sector, underperformed in September. This underperformance was partly due to concerns about the impact of inflation on consumer spending, particularly in developed economies. Woolworths Group, ticker ASX, WOW, a leading Australian retailer, felt the pinch of this trend, with its share price lagging the broader market. The energy sector, despite elevated oil and gas prices, also faced pressure. Woodside Energy, ticker ASX WDS, and Santos, ticker ASX STO, saw their share prices decline as investors weighed the impact of potential recessions in key global economies against the backdrop of ongoing geopolitical tensions. Section 7. Looking ahead, can China sustain the momentum? As we move into the final quarter of the year, the effectiveness of China's stimulus measures in achieving a sustainable economic recovery remains a key question for investors worldwide. The initial market reaction has been one of cautious optimism, but significant uncertainties remain. The long-term sustainability of debt-fueled growth, the potential for these measures to exacerbate existing imbalances within the Chinese economy, and the ongoing trade tensions with the United States all represent potential headwinds. Investors should brace themselves for continued volatility as the world watches and waits for China to find its footing. The coming months will be crucial in determining the long-term effectiveness of these stimulus measures. Prudent investors will remain vigilant, carefully assessing both the risks and opportunities presented by this evolving landscape.